Before I tell you whether I bonds are still a good investment, let's look at the rate. Interest rate on I bonds was reset on November 1st to 6.89%. This rate used to be 9.62% for everyone that bought I bonds between May and October of this year. There was mad rush to buy I bonds and it caused the Treasury Direct website to crash. I don't think everyone who wanted to buy I bonds last minute was able to get them because of system issues. And if you were one of those people, you may be asking if I bonds are still worth the money. At 6.89%, are I bonds still a good investment? I definitely think so. Everyone thought the rate was going to be about 6.48%. So what happened? Why was the rate higher than what everyone thought? Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Subscribe to my YouTube channel and follow my Facebook page to learn how to build wealth through investing. I bonds or Series I bonds are variable interest rate bonds issued by the government of the United States. They were created to help protect you from inflation. The interest rate has two components, a fixed rate and a variable rate that changes every 6 months with inflation. When you buy a bond, you will know exactly what the fixed rate will be for your bond. This rate stays constant for 30 years after you purchase the bond. The US Treasury announces this rate on May 1st and November 1st of every year and will apply the fixed rate to all bonds issued during the following 6 months. The variable rate is also set on May 1st and November 1st and is based on the CPI or the Consumer Price Index, which measures inflation. This is how the I bond interest rate is calculated. The composite rate is equal to fixed rate plus 2 times the semi-annual inflation rate plus fixed rate times the semi-annual inflation rate. For I bonds issued from May through October of this year, the fixed rate was at 0% and the semi-annual inflation rate was 4.8%. That made the composite rate for an I bond issued between May and October 2022 to be equal to 9.62%, which is just twice of 4.81% since the fixed rate was at 0. Before the November 1st rate came out, everyone thought that the fixed rate was again going to be 0%. However, it was 0.4% when it came out. And the inflation rate was 6.48%. So that made the composite rate equal to 6.89%. Now, when you buy an I bond today or anytime until the end of April 2023, you will get an annualized interest rate of 6.89% for the next 6 months. The rate will change when the Treasury will reset its variable rate on May 1st. The fixed rate for your bond, if you buy it now, will stay constant at 0.4%. So let's say the CPI drops to 4% in March. That's the reading that will go in the variable rate for May 1st. I don't know what the inflation reading will be. I'm using a hypothetical value. So that will make your composite rate equal to 4.41%. Let's see what that means for your 1-year return. So let's say you buy I bonds worth $100 on November 28th. You will begin accruing interest from November 1st. The interest rate on this bond will be 6.89% for the next 6 months. That will translate to 100 multiplied by 6.89% divided by 2 because you are earning interest for the next 6 months and the rate quoted is an annualized rate. So you have to divide it by 2. So that will make your interest dollar amount equal to 3.24%. At the end of 6 months, which will be May 1st of next year, your bond will be 100, which was the original bond value, plus 3.45, which is the interest earned, making it a total of $103.24. On May 1st, your interest rate will be reset based on the new interest rate that will be set by the Treasury on May 1st. Let's say this new interest rate is 4.4%. 4% based on an inflation rate of 4% and a 0.4% fixed rate. And this is how you will calculate the interest. 103.45 times 2.2, which is just the 4.4% divided by 2, because it is for the next 6 months that you will have this interest rate. That makes it $2.28. Adding this interest to your bond value, new value of your bond becomes 105.73 on November 1st of next year. Effectively, you will have earned an interest rate of 5.73% over the whole year. Now, is 5.73% guaranteed annual return a good return? I think so. Again, I don't know what the new rate will be on May 1st because I think inflation is cooling. So I'm using a conservative guess of 4% inflation. But before I tell you more, if you found this information useful, please smash that like button and share this video with one person who may gain value out of it. And if you haven't already, please hit the subscribe button and click on the bell icon to get access to my latest videos. If you're watching me on Facebook, don't forget to follow my page. Please comment below what you like and what you want to hear more about in my future videos. And if you want to learn how to invest in the stock market, don't forget to watch this free course on the basics of stock market investing for beginners. We have had a period of high inflation in the United States, which makes Series I bonds very attractive, even more attractive than other asset classes, typically believed to deliver higher returns. The biggest positive is the almost risk-free nature of I bonds. I bonds are backed by the full faith and credit of the United States government. Unless the US government defaults on its debt obligations, you will get your money back as promised. There is no default risk. And if there is deflation, which is the opposite of inflation, the bond's value won't decline. You still have to pay federal income taxes on I bond earnings unless you use the money for qualified higher education for your child, in which case you don't have to pay any federal tax on the earnings. And you have a choice. You can either report the interest each year as you earn it when you file your federal taxes, even though you don't actually sell your bond and get money out of the bond, or you can defer reporting this income until you actually get your interest. You don't have to pay state or local income taxes on earnings. So good for people who are in high tax states. The smallest amount you can buy in I bonds is $25, and the largest amount is $10,000 per year in electronic I bonds. And if you're expecting a tax refund, you can buy an additional $5,000 in paper I bonds with your tax refund. If you haven't reached your I bond purchase limit for 2022, now would be a good time to invest. And here's why. You get that 6.89% return for your investment this year. And then going into 2023, you can buy more I bonds up to your annual limit before the I bond interest rate is reset. So you will have another chance to earn the 6.89% return. And that purchase in 2023 will count against your 2023 annual limit. I discussed all the advantages with you. Let's talk about the biggest disadvantage. The biggest disadvantage of a Series I bond is that your money is locked for 12 months. You cannot redeem your bond for 12 months after purchase. And if you cash your bond in less than 5 years after buying it, you lose the last 3 months of interest. So if you hold your I bond for 15 months, you will only earn interest for 12 months. You will lose the last 3 months of accrual. To buy I bonds, you need to create an account on treasurydirect.com. If you don't already have an account, click create a new account. You will then need to choose the type of account you're opening, whether it is for an individual or an entity. The application will ask for your information, name, IDs, address, bank details for electronic transfer, and so on. Once you have that account set up, you can choose the type of bonds you wish to buy. In this case, I bonds, and then enter the amount that you want to buy. This can be any amount, ranging from $25 to $10,000, rounded to the penny. There's a limit on how much you can buy each year in I bonds, but there is no limit on how much you can own. So if you already have, say, $20,000 worth of I bonds in your Treasury Direct account, you can buy up to a total of $10,000 this year. And you can buy I bonds for your children or as gifts. Holidays are coming. And those purchases will not be applied towards your $10,000 limit. The purchases will be applied to their annual limit. As with any investment, I bonds need to be evaluated for their potential return and risk periodically. Because inflation is so high, it's cooling, but it's still high. These bonds may be attractive today. If the inflation rate drops in the future, as has been happening, there may be other types of investments that may become more attractive. Also, don't put your emergency fund in I bonds because you will lose liquidity for it. At least a year after purchase. When I bought my first I bonds, I had my full emergency fund in a high yield savings account. As time progressed, the 12-month limit on the withdrawal expired. I reduced the amount in my high yield savings account and left a good amount of my emergency fund in I bonds. Because see, now it's going to be liquid. I expect high inflation to continue into Q2 of 2023. So I bonds will continue to remain attractive until then. But that's just my opinion. When May 1st rate is reset, it will likely be lower than 6.89%. So if you're thinking about buying I bonds, now may be the time, or at least like until May 1st. If you're a stock market newbie, I recommend watching this video. I have an entire series on stock market for beginners. My next video discusses T-bills, another asset that has become very attractive today. Stay tuned. And as always, don't forget to be happy, to be kind, and to be your best self. Bye.